All right, so thank you everybody for being here today. I have with me Kathy, and I know I used to know you as Kathy Moore, but you've since changed your name since I first met you. Now pronounce your last name.
That means we've known each other a long time.
That is, yes, absolutely.
Kathy Moore-Nietrzeba.
So that is a beautiful name. Where did you get that name? Is it just a marriage?
From my beautiful husband.
Yeah, absolutely.
It's Polish.
Okay,
yeah.
Beautiful, beautiful. Yeah, so do a quick. I will obviously introduce you to the people listening and watching at home before this, but give us everyone a quick introduction about who you are, what your experience is, why you're even here talking about this particular type of subject.
Years ago, when I was in college, I started interning with a firm, and they specialized working with medical and dental clients, and all they did was do the accounting and taxes and profit sharing plans and trusts and all that good stuff. And I fell in love with it and started working with them after I graduated, and I did that probably for 17 years, and then went out on my own and started with my own company. And now I have two CPAs that work with me, yeah, and a couple of bookkeepers, and we all have the glory of being able to work from our home.
Right.
And we travel around and visit all of our medical clients at their offices. So it's a really nice combination, and I love it. And yeah, we just specialize just in medical and dental.
Yeah. So I don't remember the first time we met, but I knew your name because I got I think one of the accounts we work with, I would get your email all the time.
And I would see yours.
Yeah, so it was nice to put a face with a name eventually, and I don't exactly remember, but I think I've known of you for over a decade just because of the circles that we run in. So yeah, she specializes specifically in healthcare. So today, I mean, obviously with a CPA sitting here, we could talk about a myriad of different things. So what we thought we'd do is we kind of break it up into some pertinent information based on the time of year. So we're at the end of 2019 right now. I'd like to talk about a few things. So what I thought we'd talk about is depreciation, specifically Section 179, sure, or the bonus depreciation you and I were just talking about, because I know a lot of you are probably watching this are getting hit by reps, the capital equipment reps, whether it's whatever machine, whatever laser. They're probably bringing this up, the fact that you can buy this and then write it off, and sometimes they're not quite using the language they should, and what that actually means from a financial standpoint. So definitely want to talk about that. Okay. And then some other issues as far as year-end tax purposes, like what should medical practices be doing at this point in time to maximize their tax savings. Or minimize it, right? Tax exclusion.
Yeah. No, minimize taxes, maximize savings.
There you go. Right. Okay, perfect. Good. So let's jump into the depreciation thing. Section 179 or bonus depreciation. Tell me what those are and how it applies to medical offices.
Okay. Well, we have two, and we've always had Section 179. Years ago, it was just limited to $25,000, and it stayed there forever. And then a few years ago, they increased it. Well, really more like 5 years ago, they increased it to $500,000. And then in 2018, with the new tax laws that passed, it was increased to $1 million, which is a really large number.
It is a big number.
It's a big number. And so that's great. So that means, whenever you have a piece of equipment costs $100,000, you can immediately write all of that off in the current year against your collections to decrease your taxable income. And instead, you would have to do it over 5 years for medical equipment,
right?
And you're usually paying for it in the first year, or and even if you put it on loan, even if you get a loan for it, you can still write it off the first year, right, completely.
So and again, I know we're going to be talking to a lot of hopefully doctors and practice administrators. When you say something like write it off against your collections, that's when you hear it, it sounds a lot like CPA talk, and they kind of zone out because I've been in these conversations before. So what does that actually mean? Again, I think we talked about the example. Let's just use very, very easy numbers. Let's say there's a single practice solo practitioner collecting $1 million in revenue, okay, $200,000 in cost of goods sold, $400,000 in operating expenses. That's leaving he or she a net of $400,000, correct?
Right.
So where in that P&L, where in that situation does the write-off take place?
Well, you have this person come in, they sell you a $100,000 piece of equipment, and then you would take that bottom number, the $400,000,
right,
because you've written off all your operating expenses, and then you say minus the cost of that equipment, $100,000, 400 minus 100, that's 300,000,
right,
and that's the number that you would pay taxes on.
As opposed to the 400,000.
Yes.
That's it. So that's,
and I mean, if you're in the top bracket of 37% federal and 6% state, that's going to be a $43,000 number to you.
Jeez.
It's a big number.
So that's a big number. So hopefully that gives a little context to what, you know, some of these reps are talking about and how it actually impacts you from a financial standpoint. I've heard verbiage out there of reps using it, and it almost sounds like they're talking about a tax credit, which is completely different.
Very different.
Than a tax write-off, right?
Yes.
So I want to make sure that that comes across, because I know they're going to bring that up, and I know that you're going to wonder what the heck that is and how that impacts you. So that was good. So what's the difference between that? Well, are we done with Section 179? I know there's some things here that we've made some notes here so we can stay on track. I see this. I mean, this doesn't look like when it first rolled out. There's some things on here that are new to me.
Yes.
Okay, talk about that.
There are.
Okay.
And that's exciting about Section 179 because used to anything related to real estate was not involved in Section 179. It was just going to be your furniture, your computers, your medical equipment. Now they actually, if you go out and you need to get a new roof on the building, or you need to... what are some other things?
HVAC.
Yeah, the HVAC, which is a really expensive thing. Then those items can be written off under Section 179 completely in the year that you have to, you know, outlay the money. And that's a great thing.
Yeah.
Yeah. One thing about Section 179 to remember is if you ever have enough items in a year that it causes you to have a loss for the year, then you can't actually take that loss and use it. You have to just go down to zero net income with 179, but you can carry it to the next year and utilize it in the following year.
So going back to our simple example of the doctor that had a $400,000 net income, and let's say they spent $450,000 on capital expense, you can't get down to negative. You have to just stop it.
Yes, you can only go 400,000 minus the 400,000 section 179 and carry the 50,000 to the next year.
Perfect.
It's not lost. You'll get to use it.
Right. So is there a limit on that?
No, you can carry it forward indefinitely until you use it up.
Well, there you go. So what's the difference between that and the bonus depreciation, which is a new word that we were talking about, which I don't even know about. Okay, say you're going out and you're going to buy a new computer, and it's depreciable over 3 years according to rules. Now the IRS is saying we're going to give you 100% depreciation if you're a small business, which all of our medical practices are small businesses. You write everything off in the first year. And one thing good about bonus depreciation is you can incur a loss with it. Okay.
You could buy a whole lot of things, and you can actually go negative. So in the example you had before, you could show that $50,000 loss and flow it through
to their personal,
to your personal return.
Gotcha.
Yeah.
Okay. Is there anything else different about bonus? And I think we talked about this. When she first said it to me, I was like, "You get to write off bonuses?" No, that's not. It's not exactly what it is. It's just a bonus.
Yes.
Addition.
Yes, because years ago we had to write off equipment over 5 years, and you couldn't write it off the first year. It didn't matter if you paid for it all the first year. You had to write it off over 5 years. Then about in 2013, they came out with what IRS did with what they call bonus depreciation, and it was 50% bonus. So they said, okay, we're going to let you write off 50% the first year and then do the rest of it over 5 years, okay?
Yeah.
And now this is new, and this came into place in 2018 with the TICJA rules that came into place.
Okay, so it's relatively new.
Very new, yeah.
Okay.
And now it's 100%.
Okay.
And most of the time I actually go in with most of my clients and just automatically take the 100%. But if they have any, like a new HVAC or a new roof or something that is a real estate item that is qualified under Section 179, then I'll throw 179 on that.
So you'll use both depending on what type of expenditure there was. Okay.
Yep.
Perfect. Hopefully that gives the people listening and watching at home some ideas about what this can do for them if they have the right CPA in place, and how that can affect their tax picture at the end of the year. So let's talk about some other things here. We've got a lot of different notes here. I'm going to let you take it where you want to, but we're at the end of the year. A lot of tax planning purposes can be done right now. Where would you start on the notes that we have here? There's a lot here. I don't know how much we'll get to, but where would you start?
Well, with our clients, what we do is we're obviously preparing their financials every month because they're a medical practice and they need to see that so that they can make good decisions during the year. But every quarter we get together with the clients and we put together a personal tax projection. and we take where the company is or where the practice is so far, and we'll project forward. Well, it's really great when we're doing it in October, because October is great. We have 9 months worth of real deal. We're not projecting anything. We have 9 months of actual to look at.
Sure.
So we go in and we say, okay, what are we going to do in bonuses this year? Because we're projecting you're probably going to have some income. It's going to be higher than last year. Do you want to get bonuses this year? And if you do, you start assembling that.
So can I stop you there? The bonuses, and you're talking about to the doctors or to the owners or to the staff?
I would say to the staff.
Okay.
And the doctors too. I mean, the doctors ultimately get to make that decision once we get to the very bottom line to see what's left over.
Sure.
But yeah, sometimes people, they like to give bonuses every year to the staff, and it's a good time to determine if you can even afford to do that.
Right. And so when I was a consultant, I would get these calls from some of my accounts saying, hey, should I do X, Y, and Z because my accountant said I need to pay out these bonuses? Is it the same kind of situation where, again, let's go back to the simple example of the doctor that's making $400,000 net income. Let's decide that he or she wants to spend $50,000 in bonuses. I'm just picking a round number. Mm-hmm. Does that drop that?
That's exactly what it does. It will take the 400 down to 350.
Okay.
And the 50,000 times 43% is how much you're saving. So that would be what, 20-something thousand?
You're asking me to do simple math in my head, and I can't do it.
I think about 21,000.
Okay.
Yeah, if you're in those top brackets.
The smartphone is taking that part of my brain away.
Well, and that's just a good thing to do with your staff anyway.
Yeah.
It's just a great thing that we try to put together for staff every year anyway, is to take, we know what their W-2, their salary is going to be. We know what their bonuses have been during the year. We know what their health insurance benefits have been. We try to take all the 401k, if you do any matching or whatever, and we put all those together, and we show them what that is. I mean, we want to get staff, and we want to keep staff.
Sure.
Yeah, we don't want to be retraining people because that costs money too.
Oh,
so
moly. Okay, so that's something we can talk about. Go ahead.
Okay, we can also, it's a time to think about maybe accelerating expenses, because your CPA is going to know what bracket you were in last year. They're going to know how profitable your practice is this year. They're going to know if you've sold any stocks and bonds, or a piece of property is something that maybe is generating more taxable income for you this year. So you may want to go in and accelerate some of your expenses.
Okay.
And I first look at what I do first is say, okay, let's pay everything that's due by December 31,
Sure.
Then let's turn around and say, hey, why don't we prepay January's rent?
Okay.
Why don't we prepay, the malpractice? That's a big one.
Yeah.
Or just a big medical supply bill. I know some of these medical supply bills are huge, and cosmetic supply bills are really big.
So you're suggesting pulling in that month of January
into December.
Right. So it affects.
And you only do that because you're comparing. I mean, it takes a knowledgeable CPA that you sit down together, you look at the year prior, you look at this year, and you know what this year is going to be. And then probably can project what next year's going to be looking like, and you make that decision. Okay. It's not just something you just do. Yeah, because you could lower this year, and then next year's going to be really, really high.
Right.
So you really have to put some thought into it.
Okay. But yeah, the medical supplies and the things like gauze, bandages, the McKesson orders that we all have. Allergan bills.
Oh yeah.
Yeah. So.
I want to be Diamond. Remember that? I've heard that one a lot.
I bet you have. I bet you have. Yeah, absolutely. What else?
Okay, many of our doctors have retirement plans in place.
Okay.
And 401k plans, or maybe a simple IRA. And you want to go in there and make sure that you get with the TPA, which is the person that puts the numbers there and tells you what your max can be, and what your minimum can be. And then you get with the doctors and say, okay, if you do the max, this is where you are. If you do the minimum, and you give them choices.
Yes.
And you want to make decisions on that. Now, you have until March 15th when you file the tax return the following year to get it paid in.
Okay. So that's 3 months.
Yeah. So it's a good thing. It's something really good. That's why I really try to pull my numbers together in December and get them over to the TPA quickly, so I can get some numbers back, so we can make some decisions.
And are the doctors telling you, and again, say you meet with them in October sometime to plan for this type of thing, are you picking a number, like I want to have this much come to me at the end of this year, I want to make X number of dollars, and then you're kind of backing into how many deductions and how many of these different things you could take, or is it?
Sometimes.
Okay.
Sometimes you have that luxury of being able to do that.
Okay.
Yeah.
There's
And
enough.
it just, cash flow dictates everything.
Okay, yeah, absolutely.
And, you know, and some people have, I mean, interest rates are relatively low. You can get equipment now, you know, relatively cheaply. So I have a lot of people that will go out on December 31 and sign a loan and know they're going to pay it off in a year or two and go ahead and buy a big piece of equipment. And as long as it's in your office and in place, then we can, by December 31, then we can take that deduction.
Perfect.
All of it, even though you haven't paid 1 penny towards it yet.
Good to know. All right. What else we got here?
Okay. Another thing that is gone this year is entertainment, and yeah, good old entertainment.
Dang it.
Can't take people to the Braves games anymore, or the Falcons games, or buy those nice boxes,
Sure.
or those golf tournaments.
Yes.
But you can do golf tournaments if they're charitable.
Okay.
And you can do anything that's charitable. You just got to keep your receipts.
Mm-hmm.
And that is another thing about charitable. We'll segue into that. Is that they're becoming a lot. The IRS is becoming pickier about requiring you to have written acknowledgement from the charitable organization if you donate $250 or more, and that's really important. I mean, I really have only had a few audits over my career, but I have had many paper requests from the IRS wanting to see backup for charity.
Yeah.
Many I have.
Yeah, I'm sure that.
So,
sure, things get lumped into charity sometimes.
Oh, I can't tell you. Sometimes clients, I'll say, "What was your charity this year?"
Yeah.
10,000.
No, not really.
Yeah. Let's see. Another thing is 1099s. That's one thing that people they don't realize is when you're paying vendors during the year, you really need to be getting W-9 forms completed before you give them the first check. And the W-9 form, they have to put their name that they want the check written to, their EIN or their social, and their address.
Right.
Then you have it on file. Then at the end of the year, your bookkeeper can come in, pull the total amount you've paid them during the year. If it's $600 or more, then you have to go in and issue that 1099 to them, and it's due to them by January 31 of the following year.
What's the difference between a 1099 employee or contractor in this case and a vendor? I sometimes, even when we work together, you're like, is this a vendor or is this a contract? Like, is there a distinction between that?
If they're incorporated.
Okay.
If they're incorporated, then you do not have to issue a 1099. But if they're legal, you always have to enter. Isn't that funny? Because isn't most of Congress lawyers? I don't know why they made it. If it's illegal, you always have to issue a 1099. And then if they're not a corporation, then you don't have to.
Right. So
$600 or more too. If it's under $600, you don't have to issue it.
So we had an individual. I'm just going to use this as a case because I know once people get started talking about some of this CPA stuff, they kind of zone out. But in a real world case, we had an individual cleaning our office, just an individual. I'm sure that we're going to 1099 her.
Right.
Yes. Yes. And then, and obviously you know who this person is because you do our books. But we since have brought in a company, like a legitimate company, big brand name. Do they become a vendor now, or is that still a 1099?
They will be still coded to janitorial because that's where we'll put it.
Right.
And we'll look at the total, and if it's $600 or more, we're going to send it to our client. And then the client will look and see if and find out if they're a W-2 or, if they're incorporated or not.
Okay.
Yeah.
So in the case.
And you're going to find that out when you fill out the W-9s.
Sure.
If you get the W-9s on them and send those to your CPA, they'll have them on file. They won't even have to ask that question.
Gotcha.
Yeah.
Perfect. All right. What else?
But that's really important because if you do not get the 1099, you really are not supposed to take the deduction by law. So,
Yeah.
You
That's a
want
big
to do
deal.
things right.
Yes.
Okay. Sales taxes. I put this one down just because I was telling you. I've worked with a lot of dermatology practices. I have some veterinary practices, and I go in and they don't even know because they're selling maybe some sunscreen.
Hold on. Time. I'm gonna stop it and then come back on because, like I said, that'll.
I need a drink of water anyway.
Yeah. All right. So we're back on now.
I'm going to start.
All right. So talk about sales taxes.
Yes.
So sales taxes. So you work with obviously a lot of dermatology practice. Retail is a big thing in these particular practices, even some vet practices you're talking about.
Well,
So tell me,
because you think about it, you go into a veterinarian and you're take pets in, get them seen. You, oh wow, look at these nice leashes that they have. Or, oh wow, look at this great dog food. Well, I go in there and they're not charging sales tax. They're not collecting it. I mean, it's not like they're trying to make money on it. They're just not even charging it because they just don't know they're supposed to.
Right.
But you are supposed to. And Georgia is very, very active in researching and walking into practices. They'll just go around and walk in and check to see if you're doing it. So that's something you need to do. If you're selling anything, if you're selling sunscreen, which a lot of the dermatology practice sell sunscreens and all kinds of products.
Sure. Multiple locations, because I actually got a call from the state.
Yep.
So because the way it was set up initially was set up all under one, but it's supposed to be broken out because each county.
Each county wants their part, and they all charge different rates.
Exactly.
So, but it's one sales tax return that we prepare, and then and typically I would say, I mean, some practice administrators like to do it, but it's something that your CPA can handle for you too, and you don't have to deal with it.
Yeah. Perfect.
What else do we have done here? Another thing. If you're a practice, you know about this. Every county that you have a location in, you have to send a copy of your depreciation schedule to them along with a personal property tax return every year. And that's due by April 1st of the year following.
Okay.
And it just tells them everything that you have. All your computers, all your furniture, everything that you have.
Yeah.
And then they assess what they call a personal property tax on that, and you'll get the bill later, usually like in June or July, you'll get the bill based on the return that we file. So, even though you have completely written off some of your equipment and furniture and stuff that's on the depreciation schedule, even though it's all written off, you've taken all the deduction for it, and it's zero on your books, they still will charge you a minimum amount of tax on that until you literally remove it from that schedule. And so that's why every year in December we send those schedules to the client and say, please review this. Please mark through anything that's obsolete, anything that's gone home with you and it's not in the office anymore, or anything you're just not using anymore. Give it to charity, and then we go in and we take all of it off, and it will reduce your bill. So that's something to think about. I see that all the time. Yeah.
So, and this is specifically
not being addressed.
And this is nationwide.
This is
Every county does
every county. Oh yeah.
Interesting.
Well, I say every county. I've not worked in every state.
Sure, I know that.
But I have worked in a few states.
Sure, but in those states, every county is requesting all these assets to be listed out.
Absolutely, because they're going to charge you what they call a personal property tax. Well, I mean, your cars get charged, right? Your homes get charged, right? Your land gets charged. You get charged. Your equipment gets charged.
Everything in the building gets charged too. Oh, okay. What else have you got on here? Anything else?
I think we've covered everything as far as year end. There are some new things under the Tax Cuts and Jobs Act, which is called, they call it TICJA, is their little name. They always like to have a little name for them. But this is what came out in 2018, and this is when we started hearing, oh gosh, should we be a C Corp or should we be an S Corp? Because, Donald Trump and them just lowered the taxes to 21% for corporations.
Sure.
And we all know that an S Corp passes the taxes, is not taxed at the S Corp level. It passes the net income to you personally.
Right.
And you pay at your personal level.
Right.
Which could go as high as 37%. It's a graduated tax, but it goes as high as 37% for federal. So you're looking 21% and 37%. You're thinking, wow, I need to be a C Corp. This S Corp thing is not for me anymore. But we did a lot of research into that, and we took a lot of continuing ed on that because I wanted to make sure I was advising people properly.
Yes.
But the high majority of the time, the S Corporation is still good for medical practices because at the C Corp level, yes, you will be paid 21% on your net income.
Yes.
And then whatever you take out as W-2 income, obviously, goes to you personally. But you'll pay 20% on the net income. Then when you want to take out all that money that's left over, that net income stuff, then you have to pay 20% capital gains tax because it's called a dividend when you're in a C Corp.
So let me go back to the doctor. Okay, the doctor, he or she that's making $400,000.
Gotcha.
If they decide to stay C Corp, because they've gotten wrong information, or maybe they think this is the best way to do it.
Right.
That $400,000 net income, they're automatic, because they're a C Corp, they're automatically going to pay 21% on,
Yes.
which is $84,000.
Right.
So that would be deducted from the $400,000. See, I can't do simple math in my head anymore. Leaving them 316, right? That they can take home. I'm using the air quotes here. Is that right?
No.
No?
That's not really how it is. Okay, say we have $400,000 in net income.
Yeah.
Okay, it stays in a C Corp. You pay tax on it.
Right.
And the tax is 21%, and the C Corp pays that tax.
Okay.
Okay, the federal tax is never a deduction. It's a non-deductible
Okay.
thing, so you never deduct it.
Okay.
But anyway, you do have that $400,000, and you've paid tax on it. Then if you want to take it out later, whatever you end up taking out, let's just say it's the $400,000 because we're going to try to compare. Then you're going to pay 20% on it because it's going to be called a dividend, because you're taking out what they would call retained earnings that are in the C Corp.
Okay.
So 20% to capital gains plus the 21% is 41% tax.
Before you even pay personal taxes on it.
Right. Well, you're not going to pay personal tax on this.
Oh, you're not?
No, 21%. What you're going to pay is the 20% capital gains.
Okay.
That's your personal tax because it's a dividend.
Gotcha. The IRS looks at that as a dividend.
Yes, and you would pay tax. Yeah. And
as opposed to a distribution.
Exactly. Because an S Corp is a distribution. And an S Corp, it can get complicated. But
yeah, obviously, which is why I have you here.
Yeah, it can. But think about it. If you're taking it out through an S Corp, you're going to pay 37% top bracket.
Right.
But it's going to be graduated. It's going to go up to different tiers. So it's not all going to be 37%.
You hear that a lot. Like, I don't want to make over X because I'll be taxed at
into
X.
another bracket.
And it's like, no, you taxed as you go.
You're taxed as you go up, yeah.
So.
And it is smart to do planning, because sometimes maybe you don't want to sell something that's going to give you more ordinary income to throw you into a higher bracket. And if you wait till the next year, and if it's only a month, you might be better off.
Right.
So tax planning is that's it.
Yes.
Yeah, that's the fun thing. That's what you got to do.
Well, I think anytime that, and again, I love business and love P&Ls and balance sheets, but anytime I hear the word taxes, like I get super.
Oh, you would love it.
No, I don't. No, I hate it. I hate it. I just, the old saying, I don't fear anything but God and the IRS.
And the IRS.
It's like,
well, I have to tell you.
It just makes me so nervous with this type of stuff.
I still kind of get a little bit
when
I see the letter come in the mail.
Yeah, I bet. So, but yeah, for those type of purposes, I think this is valuable information. Most of our practices, like you said, are S Corps. So most of them, do you recommend them taking a salary or doing the distribution?
You have to do both.
Oh, you have to do both.
The IRS requires that you're supposed to take what they call a reasonable salary. And, if you're a surgeon, then you have to go in and kind of determine that and benchmark it and look around. And we have sources that we can go in and research that for you and just make sure it's reasonable. I always want to keep it on the low end of reasonable, but we want it to be reasonable.
Right.
And the reason why we want to keep it low is because everything that comes to you via W-2 as compensation is taxed for federal, for state, but it's also taxed for self-employment taxes, your FICA taxes, Medicare taxes, and you have to match that too through the company. So it's kind of double.
Yes.
Even though you do get a deduction for part of it, but it's expensive. Yeah. So we want to keep that low.
Okay.
Then when you take your distributions, those are not taxed with self-employment tax. They're just federal and state taxed.
Gotcha.
So, yeah.
So the idea being, find out what your reasonable salary is, take that in form of W-2, and work with
work with your CPA to get the distributions and take the distributions as cash permits, obviously.
Obviously.
That's a hard one to get across sometimes. Our collections are down. Why can't I still take,
X, Y, and Z number. Yeah, I can imagine you have those conversations. Well, I mean, we've been going for almost 40 minutes.
Have we really?
Yeah.
Okay, it's fine. We have more.
You tell me. You tell me what else we have on here, because we can.
Well, we do get what's called a qualified business income deduction when you're an S Corp. And that was not there at first. When they first come out with all these new rule change, we're like, okay, you have forgotten the S Corp people. What are you doing here? You got to do something for us. Throw us a bone.
Yes.
So this is what they threw us.
Okay.
And they gave us, it's called a QBID, Qualified Business Income Deduction. And it gives you a 20% deduction. that you can offset against your income at the personal level. In other words, whatever your practice income is, your net income flows to you on a K-1.
Sure.
And the K-1 flows to your personal return.
Okay.
And then you put it on your return.
Right.
You put your W-2 income on your return. You put your interest and dividends, all those good things.
Right.
Well, now you also get a calculated 20% deduction that goes against your K-1 income. So it helps to reduce it.
And this is just a rule they put in place?
It is. It is for service businesses.
Obviously, which all healthcare professions.
Which all of us are,
right.
Yeah. And it has caps. If you're married filing jointly, it's 20% up until your taxable income is $315,000. Then it starts to phase out slowly between $315,000 and $415,000.
Gotcha.
Okay.
And if you're single, the number changes.
Single is $157,500 up to $207,500.
Okay.
And we kind of have a joke about it. We kind of say you're either a hamburger client, a steak client, or you're a caviar client.
Well,
if you're below $315,000, you're the hamburger and you get the full deduction. Okay?
Gotcha.
That's what I am. If you're in the middle, in that phase out area,
sure.
You're some cut of steak.
Okay,
right?
okay.
And then once you go up above the $415,000, you're caviar and you don't need the deduction.
Gotcha. That's a good way of looking at it.
Well, it's just a way of kind of making it funny, but
absolutely.
when it's not so funny.
What else?
Entertainment we said was gone. But one good thing to remember, because a lot of practices that I work with do this, is they give a nice, company party sometimes at the holidays, and or for whatever reason, any kind of holiday or office party that you give is fully deductible.
Okay.
So
this made me think of something as it relates to entertainment parties and those types of things. What about, because a lot of our clients have these big, massive open houses and events.
Events are deductible as advertising, marketing.
Okay.
And I think you're talking more like sparkle parties.
Yeah, like
and
you know what I'm talking about. Yeah, with these types of things.
Where they're promoting like maybe certain kind of services that they do.
Sure.
Then definitely that would be advertising or marketing.
Okay, so it's definitely it's not fitting into this other bucket of entertainment. Okay.
No, because yes, if you took them all out to the Braves game and rented a box, that's different.
That's different.
Yeah.
Than having an open house
you're
where
having
you're
them
giving discount.
in your office and you're showing them, you're having vendors come in and show them different products and things and services.
Yes.
That's promoting your business.
Okay.
That's advertising.
I
love that question. That's good.
Okay,
yeah.
good. I'll try to keep up. What else?
Mortgage interest, I think, is one thing. It used to be $1 million. Whatever your mortgage interest was on $1 million, you could deduct. Anything above $1 million, you couldn't. Now it's been decreased to $750,000. So they're trying to cut back
on that particular one.
On that particular one, yeah. A lot of people are not having enough to itemize anymore anyway because of the limitations on state taxes on your Schedule A. So they limited it to $10,000. And used to state taxes, you would take all your Georgia withholding that you did during the year.
Right.
You would take your real estate taxes.
Right.
You would take your ad valorem, and you would add all that together. Well, that could be a big number if you have a lot of Georgia taxes.
Sure.
Well, and then they add it together and they say, even if it's $55,000, you can only deduct $10,000. So it's really made people's ability to itemize a lot lower.
Sure.
I mean, they just don't meet it because in so doing that, they also went and increased the standard deduction to $24,000. So that's a pretty big number.
Yeah.
So you compare the two, and whichever's higher, the itemized or the standard, you take it. Well, I'm seeing more and more people take the standard. They take the $24,000 because it's higher.
Absolutely.
Yeah.
So, with the mortgage interest deduction, why did they lower that? I figured that if anything, they would want to encourage. Is this just something?
Well,
is it just one of those things that they decide?
It's just one of those things, and I really haven't heard necessarily why. I'm sure they had reasons.
Yeah.
I think they were putting increasing the standard deduction because there are a lot of people out there, middle income people and lower, that really don't have the ability to buy homes, or people coming out of college that don't have the ability to buy a home.
Okay.
And they were trying to equalize things by making that deduction higher and maybe sharing some of that kind of a deduction benefit against taxes with them.
Okay.
Just to kind of equalize things a little more.
Interesting.
Possibly.
Okay.
That's kind of my theory.
I mean, not that I have $1 million note or anything like that.
Me neither. I don't have a 750 either.
I don't have 750 either. All right, what else?
Well, we talked. I had about the bonus depreciation section 179 because those were two new things that happened.
Yes.
But I think we've kind of talked that one through.
Absolutely. So
planning. That's what I say. If you have a CPA and they haven't talked to you about planning this year, get on the phone or get on your email and call them and say, hey, let's get together now, because we still have October, November, and December. You know, if you're under withheld, they can run a quick projection for you, and they can say, hey, on your last 3 checks of the year, let's withhold this, or let's make an estimate in January, by January 15th, and get it in for this year, to avoid penalties, and just so you don't have to stroke that great big huge check in April that you're not expecting.
I think that's the main, I've heard doctors say, it's
know.
terrible to think that there's these $1 million businesses out there that aren't getting this type of advice, and then you show up to their office to do whatever you got to do, and they're in a bad mood because they've got to stroke a large check because they didn't plan for this type of thing.
And it's
terrible.
Bad. It is bad. And they don't. And you said, well, you should have it. Well, okay.
Yeah, but you weren't planning on stroking a big check like that.
Exactly. And the bad thing is sometimes they'll come to you, and the client can't get you all their information till the last minute. You throw everything together, and then if you haven't done any tax planning, on April 10th, that's not a great time to tell them they owe $50,000.
Exactly.
Yeah, no.
Yeah, and it happens way more than you would think.
People that want to work with me and they just want to be a one-time-a-year client.
It's not great.
I make them commit. They have to do a tax projection for me at least once.
Because you know what's going to happen.
Because I'm not sitting in the seat to have to tell them they owe that money, all that money. I like to have good news for clients.
Yes, absolutely. So hence the reason of tax planning at this point in time of the year.
I know something we didn't talk about because we're in Georgia. Yeah. I know where you're going to be showing this, but in Georgia there's some really good credits for practices.
Yes.
And I think you're going to have someone speak about this later in depth. But Georgia retraining credits. If you're a medical practice or dental practice, you need to look into these. And you can do it now. It's not too late. But if you wait till December, it's too late.
Yes.
So you need to look into them. You can, that is a credit. It's a dollar for dollar refund. And you can get up to $1,250 potentially per full-time employee.
Right, so if you got 10 full-time employees, that's a big number. A lot of the practices you work with have way more than that.
Oh yeah, we got $100,000 credits.
Exactly, so that becomes a big number if you just know that that's out there and can apply the rules to the training. And again, it's going to be David McMillan who I'm going to be talking with about this. And
I work with him too.
Yes, and you're the one who introduced us. You would be shocked at the tax credits available. I was like, what? You can have a credit?
Do that?
Yeah, you can have a credit for that?
And it's just sitting on the table. Then you're really missing out if you don't get in there. So mention it to your CPA. Don't wait for them to tell you because they may not know about it.
Right.
Because I specialize in medical and dental, so I see all this.
Right.
But if you have people that are working in all different fields, they can't know everything.
Right.
So,
or they don't want to bring it up because they may not know the details. They don't want to look dumb.
Don't really know how to do it.
And,
and that's why I engage David's help, because he has the relationship with Georgia Department of Revenue, and it works out really well. We're a great team.
Yeah, and again, check out that podcast because I think it's going to be very, very valuable specifically for the people in Georgia. But that happens in other states, correct?
There are some other states. I do not work in a state that does it, but I have heard that they do have this in other states as well.
So reach out to your CPA. It doesn't matter where you are, and just see if there's any tax credits available. Who knows what's going on in your state? But obviously we're in Georgia, and so that's a big thing.
And we also have Georgia film credits.
Yes.
Tag those again. Those are at the personal level that you would apply those. But still, if you know you're going to owe $50,000 or more in Georgia tax, maybe you just don't want to withhold any tax during the year. Figure out what it is the 1st of December and go out and buy the credits. And you can buy them for 89 cents to 90 cents on the dollar this year. And that kind of fluctuates depending on, supply and demand.
Right. So again, more details to come. Watch David McMillan's podcast. We'll talk about that in depth at that point in time. I think that's enough.
Okay.
I think you did great. I think you did. So hopefully you all got a lot out of this. If you like this and obviously are watching the video, or if you are listening to a podcast, leave me some comments, leave me some feedback, and I can have Kathy back on. She's in the Georgia area. Granted, you live far away from me in Georgia, but I'll be more than happy to go to her, or we can do this over the phone or via Skype or whatever. I think this is very, very valuable because this is the world I came from, and I see when tax planning and you have a good CPA working beside you throughout the year, how this plays out not only in just making better business decisions, but also paying less in taxes or not stroking that big check at the end of the or
building
April.
your wealth.
Yeah, building wealth. Right, exactly. So how can people get a hold of you if they see this and they're like, I want to talk to her?
Oh, okay. You can email me at kmoore, K-M-O-O-R-E, at kmncpa.com, or you can call me 678-960-8766.
Yeah. Do you have a website?
I do, kmncpa.com.
So there you go. That's how
Pretty
you get
simple.
Yeah, it's pretty simple. And then obviously I'll leave links to if you're watching on YouTube, I'll leave links to all that in the descriptions. But thank you so much for doing this. This has been amazing.
Thank you for inviting me.
All right. Thank you so much.